Good morning. I'm Richard Calhoun, real estate broker with Creekside Realty, 40 years serving consumers here in Silicon Valley. We're here to talk about the real estate market, week number 42, what's happening, and we'll get back to the URLs in a little bit. This slide is the first data slide. The real thing that stands out here is this huge drop off in new listings. It doesn't concern me one way or the other because you're only looking at 1 week and you have a lot of fluctuation. It's still about the same order of magnitude where you'd expect it, but just last week we had 35% more listings come on the market than you would expect. This week we're essentially at 100%. So we've lost almost a third of the new listings, which is going to make it hard for buyers this weekend. There's a lot less inventory for new inventory for them to pick from. Overall inventory is the blue line, and it's still really unchanged, but obviously way below the 100%. The 100% line is the gold line, which is 5-year median 2015 through 2019. Inventory is clearly on the low side. The new stuff coming in is right essentially where you'd expect it to be. But again, what's standing out is the demand is way above where you'd expect it to be. We're probably at 30% this last week above where you'd expect the demand to be. So the buyers are coming out of the woodwork for whatever reason. Sellers are not flooding the market. Sellers are coming on at the right level of that you'd expect them to be. So the result is we started off the year at 140% of inventory. We rapidly got down to normal inventory, and then we got down to 80%, and now we're down at 70%. And this is both counties, San Mateo County, Santa Clara County combined, both types of properties, single family homes and condos and townhouses. So what's happening in any given marketplace can be quite a bit different than the macro data in a big blender. Days of unsold inventory is the single biggest indicator to me on what the future is going to be doing. It's the supply demand balance. So again, the yellow line is where you'd expect it to be the 5-year median. And I should point out those 5 years that I use are the 5 before COVID, but they happen to be 5 really good years. We're comparing to 5 really good years, and we're having a fantastic year compared to 5 good years. So that's pretty unbelievable when you really think about it. And again, if you come back to the beginning part of the year, you were sort of normal, right on top of where you'd expect it to be. But then starting in about week number 10, you basically stayed flat where the market normally starts slowing down a little bit. Basically, the buyers come out of the woodwork before the sellers do after the holidays at the end of the year. And that causes the days of unsold inventory to come crashing down because you have demand but no supply. And then the sellers start coming on the market as we start approaching spring, which is why the supply demand ratio normally slows down a little bit. This year it's been basically flat. There was a few minor spikes for the holidays, and holidays this year are essentially a week later. So you had a little bit of a crash before, an acceleration before, a crash after, and then acceleration back. And that's just the way the calendar worked out for this year. But basically your days of unsold inventory is 20. It's hard to really get below 20 when you think about it, because you're talking about selling every single property in 20 days. Properties come on the market, properties get exposed, sellers hold them on the market for a while. And if the sellers weren't holding them on the market for a while, days of unsold inventory would probably drop by about 5-6 days, and we'd be somewhere down around 14-15 days of unsold inventory. And again, that's the whole area blended together. Each area has its own characteristics. This is looking at each week. Each line is 1 week, and I'm plotting out the sale price to list price ratio of every transaction. And the purple line is the current week. And you can see it's now towards the top. So we had been sort of slowing down, and now we jumped up quite a bit, which is an indication of what happened in the market 5 and 6 weeks ago when these offers were being negotiated. But all the last 22 weeks are fairly close together, so you basically are at a plateau. What I find most interesting about this is you're sort of at the very peak here, so the market's the hottest, but you come down here, you're sort of in the middle, and then down here, you're at the slowest, because as you move up, you can see the red line here, the dotted red line is the hottest month we've ever had. The blue line is the coldest month. And what the purple line now is sort of the steepest week we've ever had, which is sort of interesting. And I'm not sure what it means because I only saw this myself a few minutes ago and I haven't been able to come up with anything. But basically, it's indicating that a fair percentage of the market's willing to way overbid. But then on the low end now, all of a sudden you have a growing percentage of the market going underneath. So I don't know if it's sellers are finally getting the price where they're overpricing their homes, and now buyers are smart enough that they won't overpay and they're coming down. I will share that the range was something like 77% of the asking price on the low side to 151% of the asking price on the high side. So that this week is the steepest week that I think I've ever noticed, because here you sort of have at the bottom end, the worst week out of the last 22, and up at the top end, you've had the best week out of the last 22. The graphics on this is a little less than normal, and that's just because I had to do it quickly, but the numbers are accurate. So this is just single family homes. I did not get time to put the condos and townhouses data on here this week, and I think I just need to train myself to put Friday's data for condos and townhouses so that you have something that's relevant. The colors are left over from last week. I just dropped off the numbers. So what this allows you to do is look at the key indicators, days of unsold inventory here in the first column. And you can see for single family homes, it ranges from 11.4 days for the moderate priced areas, which are Santa Clara, Campbell, Cambrian, and Willow Glen, all the way up to 52 days for the expensive areas in San Mateo County. But all except for the expensive areas are in a strong seller's marketplace, and the expensive areas is in a balanced marketplace. Then if you go over to frequency of overbidding, you can see that at least half the sellers in every micro market area of single family homes is getting more than their asking price, up to about 86%, it looks like, down here in the Bay Cities in San Mateo County. And then you come over to the magnitude of overbidding, and it's from 114% down to 103%. And then on the price column, you have three numbers. You have the median in the middle, you have the lowest 10 percentile on the left, and the highest 10 percentile on the right. So you can quickly see what micro market area is in your price range, and then see what those micro market conditions would be. With that, I will pause for any questions, and as I do that, I will explain these URLs. The base URL is in the green, and that will take you to my YouTube archive of these sessions. If you add the year 2021, you'll get to the Saturday presentations live at 9 o'clock. Then if you add the year, month, date code, you'll get to the specific presentation. And if you add the word handout before the year, month, date code, you'll get to the PowerPoint slide presentation here. And it is not yet posted. I will try to get it posted. And just for the record, I did not get last week's posted on the video or handout. So I may get to that today or this weekend. It was just the craziest week I've had. Pausing for questions, not having any. I will slow down now and we'll go into a little bit more detail of the different micro market areas. And during this part of the presentation, feel free to interrupt as I proceed if you would like. So here what we're looking at is simply the number of new listings that are coming on in the market. And the yellow line is where you'd expect it to be. The blue line is where it actually was. And you can see we were above the blue, yellow line for quite a bit, and then we came down and approaching the blue line. I actually thought we'd be higher for the balance of the year. There's no way to predict. You can see over the last year, this year, it's been basically right on top of the yellow line. So what people, maybe a more accurate read of it is these last 3 weeks where you had more inventory than normal coming on is making up for this week where you're basically right back down at the normal line. But it's not any one week, it's the accumulation of all the weeks that matters. There we go. So now what we're looking at is, instead of just the number of new listings, we're looking at the level of the water in the reservoir. How many listings are available for the buyers to purchase? And you can see, frankly, it's been pretty flat all year. Normally it starts off low and goes up fairly significantly. You can see maybe it triples in volume every given year. This year we started off a little bit high and we haven't gone up essentially at all. If you ignore the first week, you're at 1,500 to begin with. You're peaked at maybe 1,800, and now you're back down at 1,500. So basically this year has been flat inventory. As soon as there's any inventory out there, the buyers come along and purchase it. And again, I would expect it to drop off as we get into the end of the year, just because sellers tend not to put their house on the marketplace with the holidays. Holidays have been less of an influence post-COVID than it was before, but it will still have some influence. So now this is starting to look at the demand side. The blue line again is the data for the current year. The yellow line is the 5-year median. To the left is 2021, to the right is 2020. In 2020, you have to subtract 1 week to get this horizontal separation. So what's it saying? Basically all year we've had surplus demand over where you'd expect the demand to be. And it really started to grow here just past July the 4th, and it's still hugely above where you'd expect it to be. We'd expect to sell about 400 homes in the given week, and we're selling 500. So you're somewhere around 25%, and this is actually 500 is a conservative number, but you're basically 25% above the demand level that you'd expect it to be. This is looking at days on sold inventory over time. The three major components are Santa Clara County single family homes in the red. In the brown up here is San Mateo County single family homes, and in the yellow gold is Santa Clara County condos and townhouses. And you can see that they've all been pretty flat. They've been all in the red, which is a strong seller's marketplace. And right now the trend is they're crashing down a little bit, even though we're at record lows, essentially. Yes, we were a little bit lower earlier this year, but really not for any one component. Santa Clara County single family homes, maybe was down here around 18, maybe it was down to 17. It's hard for me to judge the raw number off the graph. Here, maybe you're now at 19. So you're within a couple days, frankly, between, even if it got down to 15 to 19 days, you can't really tell the difference. It's a fast marketplace. This is actually looking at the heat map of days on sold inventory. Again, that's the supply demand ratio. It's the single biggest indicator. Anything below 40, I consider to be a strong seller's marketplace. Anything above 80 is where you start getting into a buyer's marketplace. So these numbers across the table, except for the expensive areas in San Mateo County, are in a strong seller's marketplace. To sell a multi-million-dollar house, because everything in Atherton, Menlo Park, Portola Valley is multi-million, and to sell your entire inventory in 53 days, 52 days, that's still fast. I mean, face it. Here is the frequency of overbidding. So this is how common it is for sellers to get overbid. And you can see that, last year we were a little bit lower. We started off the 2021 low. We got rapidly up to somewhere around 75, 80%. And we've been basically staying there. I do expect that to drop off a little bit. Who knows? We're basically haven't been in this territory before. This is the frequency of overbidding for the three components. And you can see how it was dipping down earlier. And now it's sort of flattened out and sort of plateaued. So it's not getting any worse. It's not getting any better. It's sort of a plateau, but it's hard to get more than 80, 90% of your sellers getting more than their asking price. There are times Foster Cities hit 100% of the sellers getting overbid. Cupertino's hit 95%. I think Cupertino actually had 95% for 3 weeks in a row, and I thought my data was broken, but it wasn't. Every week is unique. Every seller is unique. So even 80% is pretty unbelievable. This is the frequency of overbidding on the heat map. You can see down in Morgan Hills, sort of a paler color. East San Jose, right, the expensive areas in San Mateo County are lower, only 52%. If you look in San Mateo County, the coast side of the county is a lot cooler than the bay side. And again, a lot of that's got to do with the inconvenience of the commute in and out of the Half Moon Bay, the coastal areas, the beach communities. This is the magnitude of overbidding. This is how much is any buyer overbidding on average. This includes that 77%. So, one at 77%, one at 152%, what's that math work out to be 260. So that would be 130%. So you can see that it's on the high side, but it includes the ones that are getting below asking price. So it would be higher if you're looking at what percentage are buyers overbidding on any given transaction. If they're overbidding, it's going to be higher than this 8-9% number. This is the breakdown of the different geographical areas. You can see that the magnitude of overbidding is a little bit higher in San Mateo County than it is in Santa Clara County. Even 114% in Cupertino Sunnyvale is pretty respectable. 114% in Foster City, Redwood Shores, 111%, 109, 111%. So they're all over 100%. In fact, this is going to be the cheapest in the expensive areas in San Mateo County at 103%. So you're basically going from 103% to 114%. And again, that includes the transactions that go under. We talked about this slide. I bring it up just for reference. So now we're looking at the 12 most recent weeks. And so now you can really start seeing out of the last 12 weeks, you're up here and you're the hottest market that we've had. So basically, if you read this, 25% of the sellers are getting something like 14% above their asking price. You come all the way down here and it's somewhere around 60, actually it's more like 73, 74% of the sellers are getting more than their asking price, from 74%, call it, to 77, no, 82, 81% maybe. So about 7% of the sellers are getting right at their asking price. But then if you come down here, 5% of the sellers are taking a 5% discount, and it drops off pretty significantly starting right here. So dropping from about 97.5% to 95 happens fairly quickly. That's a pretty steep decline. And as I was talking about earlier, this whole slope of this line is steeper than you'd expect. So the only thing that makes sense is some buyers are, I won't say desperate, but some buyers have been looking for a while and they're willing to overpay. So they're pushing this high end up, and some sellers are coming on the marketplace and seeing the high prices, and they're pricing their house accordingly, even though prices overall have come down. And that's, a little oxymoron that we'll get to in a second. But even though the market is absolutely on fire, the prices are lower now than they were earlier this year. This is looking at the last 2 weeks. Last week will be in the column on the right. The current week, this week, is on the left. And this starts to give you the breakdown on the macro level, the large areas. So now in Santa Clara County, we only have 49%. This is the first time we've been below 50% of the inventory you'd expect to have. San Mateo County has 85% of the inventory they'd expect to have. In condos and townhouses in Santa Clara County, you're at 99%. And in the Bay Cities, you're almost at 200% of the inventory you'd expect. So the overall inventory, if you got rid of the condos and townhouses in the Bay City communities of San Mateo County, we'd even have that number that was up there quite a bit lower. But you can see it makes a huge difference. 50% is completely different than 85% of the normal level of inventory. You can see that overall, because of the lack of inventory that came on this past week, the level of inventory dropped from last week to this week. Days of unsold inventory, you can see Santa Clara County single families at 19, San Mateo essentially at 23, condos and townhouses in Santa Clara also at 23, and Bay City condos is at 47. And you can see that the Bay City condo really slowed down from last week. Most likely it was a combination of influx of new listings and a reduction of last sales last week, causing the DUI to drop, but it's probably more to do with the inventory coming on the market than the sales, because the sales is a 5-week average, or a 5-week sales period. Active inventory tends to be pretty stable too, because usually what comes in goes out, but the level of the reservoir stays the same. So, to see a 10% drop, not 10% drop, but a 10-day drop or increase in DUI, that's normally gets your attention. Normally what I say is anything over about 5 days change in a week, you start going, hey, is the market changing? But any one data point can be a statistical fluctuation, which is why I have so much data. Now we're looking at the overbidding. That's a little bit more constant. And again, to get overbidding, you have to have sale price. So these are transactions of closed escrow. So you're looking at mostly 5 and 6 weeks ago. You're not looking at current market conditions. Inventory is clearly current conditions to some degree, because it's showing you what level of inventory is available today. At last night as 11:59 p.m. The DUI is almost real time, but to get the sales rate, I go back and I've elected to use 5 weeks, and I have a lot of reasons for using that period of time. But so you're sort of blending the data over the past 5 weeks. Frequency of overbidding, you're using 5 weeks of data, plus you have the escrow duration. So, your starting point is 5 and 6 weeks ago, and then you go back another 5 weeks on top of that. So these are lagging indicators, but it gives you just some sort of sense of what the buyers were feeling. DUI is sort of, a little closer to what they're feeling today. And if you're out there in the actual market, then you know what you're feeling. And then the magnitude of overbidding, basically you can see single family homes in both counties are around 108%, and condos and townhouses are somewhere around 104% in both counties. It is interesting that even though Santa Clara County is the hotter marketplace, basically quicker DUI, more frequent overbidding, shorter inventory supply, yet their overbidding is less. And I think it's as simple as San Mateo County tends to be a little bit more expensive, so people purchasing there have a little bit more money, so they're willing to overbid just a little bit more than those in Santa Clara County that might be purchasing in Santa Clara County for affordability reasons. This is the heat map of pricing, again, on single family homes only. The middle number is your median price. The number to the left is the 10 percentile, and the number to the right is the 90 percentile. So if we look at something like Campbell, Cambrian, Santa Clara, Willow Glen, you can see the median priced home is about 1.65. The lowest you can really purchase a home for is about $1.25 million, and on the high end is about 2.33. So yes, someone might get lucky and find a home at $1 million in that area, but it's going to be rare because there's only going to be 10% of the homes between below 1.25%. So it drops off pretty rapidly as you drop below that 1.25%. And it's just a way to give you an idea. Expensive areas here, Menlo Park, Atherton, you're up to almost $10 million on the high end. To think that 10% of the homes sell for more than $10 million is sort of mind blowing, but we have a lot of money. This is the pricing. And what I did here is to have stability. I took my denominator is the entire calendar year 2020 price for the different micro market areas. So I'm not comparing it. My denominator is not changing week to week. So basically, Santa Clara County single family homes, earlier this year, we were up to about 24.4% above what we were in 2020. Now we're down to 16.8%. So despite all this overbidding, despite the frequency of overbidding, despite the fast pace of the market, the Valley has lost basically 6% of appreciation over last year in the last several months. And a lot of these peaks were right sort of in the month of June. If we go back to the moderate priced area, the Campbell area we talked about, you're down at 17%, down from almost 21%, so a drop of 4%. So the yellow is the peak. So East San Jose actually peaked out in 26% just a few weeks ago on September 11th, but now it's down to 12%. And you can see that essentially every micro market area now is below their peak, and yet you have strong conditions. So it doesn't make a lot of sense, but buyers are not going crazy with their pricing. They're holding firm on where they think the price is. At the peak of the marketplace back in May, offers negotiated probably in the month of May. That's where sort of the peak pricing was. This is showing the current data through last night, midnight. So the 22nd at midnight, I gathered the data on the 23rd. So now what you're looking at is the average and median days on the market for what's on the marketplace. And if you look back in time, you can see that's a record low number in both categories, I believe. You got record average lower here, 51 days. So in 2017-18, but our median is lower because now the median is only 16. And then you have the price, our asking price is lower than it was a year ago, which is interesting. But inventory, we're talking about it. And this is Santa Clara County single family homes only. This is not macro data, and that's labeled down here at the bottom. We only have 612. You might think that that's right where we were in 2017, but in 2017, that data was as of November the 5th. So by the time we get to November 5th, this number I expect to be quite a bit lower. So we will have the lowest inventory this year than any year in records. And even though I only go back to 2001, I have data back to 1997, and we were never at 600 at this time of the year. And then to give you a little idea what the house is, square footage, bedrooms and bathrooms, looking at the offers, you're looking at average days of 16, median days of 8, days of unsold inventory 18. So, if you look at 18, you're not going to touch that anywhere. You got 8 just last year. So it looks like we're similar to last year, but look at your DUI. Last year, you were at 26. This year is at 18. So this is a faster paced marketplace than we've ever had by quite a bit. The sales per day. We're selling 34 and a half. It's a record high basically since 2012. But if you go back before 2012, almost every year was more. And one of the things that's sort of unique about the Bay Area is as homes appreciate above their 75 to 78 values, people tend to stay put because of Prop 13 with the low property tax. So even though the value's grown over the last 2 decades that I've been doing this data analysis, the number of sales has been constantly dropping because so many sellers are getting to the point going, we're not going to sell, because we get hit with property tax. The concept was Prop 19 was going to take care of this because people can now transfer the property tax. But I don't think people understood that people that already have equity above the 250 per person exclusion aren't going to move because of the huge tax hit they're going to have on capital gains. So it's going to take years, if ever, for that to have a positive impact in the Bay Area on the volume of transactions. In other areas of California where the people were just at their 250 exclusion, that probably is accelerating the rate of the moving because now they can sell their home, transfer their property tax, take the 250 exclusion off the table, and start getting 100% of the future appreciation of their house versus only 60%. Because once you hit the 250 exclusion and paying capital gains, you only will see 60% of that because Uncle Sam and Gavin Newsom will come by and take their 40% in the more ways of capital gains. So it will have a huge impact down the road, but I think the Bay Area is already above that 250 per person exclusion, and I don't think it's having any impact. If it was having an impact, you'd expect more new listings coming on the market every year than the historical numbers, and it really isn't there. And then you come down to the overbidding. You can see you're at 108.7% and 80.2%. And again, for this time of the year, those are record highs. They're not all-time record highs because at one point we were at about 100. I don't know if it was 108% or 112.8%, but it was higher than 108.7%. And this 80.2 is pretty close to the all-time record high. I think we might have hit 82%. But for this time of the year, it is. The closest we were was 2017 here at 108 and 75. So you're pretty darn close, but you're still higher. And then you have the median price. And the median price is 1.6 million. It was up to about I'm thinking only 1.64, but I'm thinking maybe I'm getting my 4s and 7s confused, and it might have been 1.670 earlier this year. But we are off the peak a little bit. And then you have the typical number of closings, 1,164, 1,160 just last year. Again, by the time we get to November 5th, this 1,164 may be down. So it's hard to tell that because it's so close. But you can see the last 2 years, we had more closings at this time. Now, last year, it made sense because you had the pandemic announcement. And so there was a lot of delay. This year, it's just the sheer volume of transactions. So I suspect this year will actually come in a little bit lower than the number from last year, the 1160. And with that, I think where I'm done, because this is the same type of information, but it's the calendar year and it's going back in time. So I'll put up the URLs and see if anybody's got any questions for me. Pausing for any questions. Not hearing any. I will say goodbye and see everybody next week. Take care.
Thank you, Richard.
You're welcome.